Good afternoon, everyone. This is Runhuan Feng from Tsinghua University. And in fact, the university I'm in right now has a lot of ties to Korea and a lot of research collaborations with Korean institutions. And in fact, we recently had a very, very famous Korean alumni, Mr. Kim Myung-sung. Do you know him? No? I must have pronounced the name not correctly. He's the current Prime Minister of Korea. Kim Myung-sung? Kim Myung-sung? Okay. Right. Yeah, so he actually visited the university just a week ago. And so there was a lot of celebration on campus. Anyway, what I will talk about today is basically some of the theory we've been developing over the last few years based on the practices on the DeFi, decentralized insurance industry. And so I wanted to give an introductory talk here. There's no math, no formula at all, and I hope this might be interesting to both practitioners and academics. All right, so I will talk about why there's so much innovation going on in the DeFi space, and what are they, and how do they work? Okay, just very simple question to be answered today. The insurance industry we have today, there are lots of challenges, at least for newcomers, right? The capital requirements for insurance is typically very, very high, right? And if you look at the insurance markets around the world, it is highly concentrated, right? Take China, for example. The top 5 insurers in China, they would account for 60% in the life insurance market and 70% in the property and casualty insurance market. And I just asked AI before I come up, and the story is the same in Korea, right? There are over 230 insurers in China, right? So if the top 5 get 70%, as you see, and the rest of them just running at the very thin margin, okay? So it's very, very concentrated, and there's very stringent regulatory oversight, right? There's the Solvency II in Europe, RBC in the U.S., and C-Cross in China. I'm sure there's similar requirements in Korea. So it's very hard to comply. It's very costly to comply with the regulations. I actually sit on the board of directors for one of the medium-sized insurers. I would argue maybe 90% of the time of the board meeting is focused on meeting the requirements, right? The regulator give us grades. We have, there's so many problems, and then we have to work to meet their expectations. So that's an existing issue. Also, it's because of the products, the nature of the products, insurance products. There's a very high brand reputation barrier for newcomers, right? If you buy a life insurance product that would last for 20 years, right? You wonder whether the insurer will still be there, right, when you grow old, when you need the money, right? So this is also a very challenging issue for newcomers. And also the acquisition cost is very high, okay? To get new customers. That's why it is very difficult to disrupt the industry. I spoke to a lot of the insurer tech companies in the country. They always start with a giant ambition, right? They want to use tech knowledge to disrupt the industry. But at the end, they often become just simply a distributor of the main insurers. They really couldn't, even today, right? We talk about internet-based insurance. But if you look at the business model, it's almost the same, identical to the old model with high commission, right? Instead of spending So you would think that they can acquire a lot of customers through online advertisement, but then they spend a lot of money to actually get the agents to bring this customer to online to buy this customers. So they have exactly the same model as before, even though on surface we introduced a lot of innovations. But this problem is not new. It has been studied well in economics, right? There's a very famous theory in the 90s by some Harvard professors on disruptive innovations. There are two types of innovations that are most common to disrupt the industry, and one of them is low end, right? As a newcomer, you do not actually necessarily be able to provide the most advanced technology or better services, right? In fact, if you look at the most successful startups from Tsinghua, a lot of them, you would imagine, is usually who hold the best patents, the best technology would survive. But if you look at the statistics, it's not the case, okay? It is, a lot of them actually come from the alumni of our school, the School of Economics and Management, right? Business school students, they do not have the engineering advances, but they can build better models, right? And a lot of the new disruptors, they focus in areas that are low profit for the traditional the players, right? Because the main players, they really don't care to look into the small areas with very little profit margin, right? So that's how they survive. And also, if you really can't compete with major insurers in a particular area, then you try to go look for new areas, right? Find a new track for yourself, right? So this is the new market disruption, right? Examples of this would be, for example, TikTok, right? TikTok, at the beginning, they have no competition with YouTube, right? But then they find out, there are people who are looking for shorter video clips, right? So they find a market for themselves. An example of the low-end disruption would be Netflix, for example, right? I went to Canada for grad school in early 2000s, and then Blockbuster was the main players, right? And then you rent the video, you have to go to a physical store, rent the video, and then they provided, Netflix provided a new model, right? You can rent a DVD by mail, right? Nobody paid much attention to that until 10 years later, Blockbuster went bankrupt, and the Netflix is the new business model, right? So this is how they got started. So what I want to talk about today is an innovation of insurance in a completely different market, right? In DeFi. I would argue even today it is still at very early experimental stage, right? It's gonna, like any other business, it's gonna follow the Darwinian theory of evolution. Right? There's many different models, and many of them will fail. In fact, some of the models I talk about today may fail. But you need this kind of innovation to build up over time, and then it will eventually will become a disruptor in the market. Okay, so I'll show you some of the disruptors today. So I did a lot of work in the last few years on this, and I meant this to be introductory. So I even wrote a book about the decentralized insurance that talks about many different business models being developed across around the world. So if you're interested in this, you can read this book. I will talk about today. I'll give a little introduction about the DeFi insurance. This I would argue is the new market disruption. They focus on providing insurance for digital assets. Okay, and I also happen to have two talks. We didn't actually plan this, but turns out when I prepared my notes earlier, I found out that the other two talks we have at the IME conference also relate to this. So my student, who actually couldn't be here at this conference, will plan to talk about this disrupted insurance. But I will be his substitute, so you will see me again on day one. So distributed insurance is different from DeFi. Where DeFi is a bit like traditional insurance, but then the subject, right, the coverage is digital assets. Okay, it's a bit like cyber insurance. Okay, distributed insurance is a different idea. Right, so the capital provided for this insurance is going to be provided by investors. So it's a bit like a peer-to-peer network in which they match the policyholders with underwriters who are investors around the world. So there's a matchmaking going on for this distribution of the risks in the network. Okay, so that's a different topic. And also at this Congress, we'll talk about decentralized claim process, right? In the traditional insurance, claims are processed by professionals, claims appraisers, right? But in the decentralized, in DeFi world, there's no such people. So then they have to find a way to decentralize the decision making across a group of individuals, right? And this idea is very common in all DeFi applications, right? And so we actually studied this because this is a bit of a study. This has been studied. The voting process has been studied in political science literature, right? So we're trying to compare the results from political science literature with the new decentralized voting, decentralized decision-making from this new model. Okay, we'll talk about that on Wednesday. Okay, so very quickly, in the DeFi world, instead of relying on traditional financial institutions, the idea is to replace them with blockchain protocols. Okay. So a lot of the processes we're talking about for lending, for insurance will be replaced by smart contracts. Okay, and by doing so, you have to automate a lot of the traditional methods. So the most common approach is to make the decision through a community of token holders. Okay. For example, for the underwriting, for claims process, right? In the traditional insurance, this is done by some professionals, right? If there's a car accident, you send a appraiser there to look at the accidents and judge how much payments to make. But in the decentralized world, you would have a group of people with incentives to do so. They stake their coins, right? And then you distribute their premiums to them as rewards. And in return, they have to provide the service by participating in the voting process, whether or not to deny the claim. Okay? So this is a very common, not just in insurance, but also in lending and in other types of policies. Now, what I want to talk a little bit about is the risk sharing. I think risk sharing is the main components of the insurance business, right? When you offer insurance contracts, you are taking on risks from your policyholders, right? And then in the centralized, in the traditional insurance model, the insurer has to carry all the risks, right? But then they do so by the law of large number. They can reduce the variance of the aggregate risks. They can better manage to make the risk more manageable. But in the DeFi world, because there's no traditional insurer, so this risk has to be managed by a community of risk assessors, right, or token holders. So most of the model that we're looking, in fact, all the model we have looked so far, right, whether it's traditional or in the DeFi world or any other insurance-related applications, we realize that they can be summarized in this, what we call the spatial temporal risk sharing. Okay? Now, the risks has to be exchanged among participants in some way, right? Whether it's through DeFi or other approaches. And then the policyholders typically retain some risks by deductibles or policy limits, and then the risk that cannot be shared among participants or investors, they would have to be transferred to the capital market, right? So this is where the insurance-linked security takes place, right? So we actually have a paper to look at how this is done in traditional insurance. Now, if this cannot be absorbed in a single period, then the risk will be transferred to other periods, right? This is very common in catastrophe insurance, right? When you cannot absorb all the risks, if it happens rarely, and when it happens, it is very high severity, then the risk has to be transferred over time. Okay, but this is a very general framework. Then we worked on DeFi insurance. We try to understand better how that fits into the framework of spatial temporal risk sharing. So let me give you one example. All right, so this is an example of Nexus Mutual. Nexus Mutual is the largest DeFi insurers in the DeFi market. By the way, I mean, this is very ironic. In the DeFi world, the largest insurer, which is Nexus Mutual, they account for 90% of the market already. Right? It's even worse than the more traditional centralized insurance market. So I think there is a problem. Right? There is a problem. But this has to be addressed by the industry over time. Right? It is too centralized. Right? And it's ironic to call it a DeFi, a decentralized finance. Okay, so in this model, it's done typically in this way. So you have a group of risk assessors, each of whom brings in some capital, right? And then they turn it into some tokens, right? Some called Nexus Mutual. And then they stake their tokens, right? This acts a bit like a collateral, all right? And then they form the risk pool, the capital pool for the insurance, right? So when they sell these products to holders of crypto assets, right? For example, you deposit your assets in some a sushi swap in some protocols, you want protection, right? And this is like cyber insurance that we talked about earlier. Right? If there's a hacker, right, that attack the platform and you lose access to your crypto assets, then the insurer, the Nexus Mutual, will provide coverage, provide compensation for 90% of the assets lost in your protocol. All right. So if you buy that product, the premium will be allocated to all token holders, to all risk assessors, in proportion to their stakes. Okay. Okay. For example, if you stake 10%, right, then you get 10% of the premium, right? Okay. All right, so then that gives you incentive to participate. But then you have to also perform due diligence for the smart contract, right? Because if you don't do it well, right, if a claim happens, then your tokens will be burned, right? It will be used to pay claims, right? So you're essentially undertaking some risks from these digital assets, right? From the cyber attacks on these digital assets. So that gives you a reason to actually do a good job in investigating these contracts, right? So these are the first layer of this DeFi insurance model. Okay, so the risks are essentially distributed among all the participants, all the risk assessors in that layer. Okay, but then now this is where different models, different business model vary across the industry. Some of them have a second layer. Okay, if the risk cannot be absorbed entirely in this pool created by the risk assessor, then they have the second layer. The surplus, some portion of the premium will be used to build the second layer, and that is there to essentially to absorb the excessive losses from the first layer. Okay, and that if there's a surplus, then it's going to be carried over time. Right? So that second layer, essentially, it is a spatial risk transfer, a bit like catastrophe insurance, right? Building up this reserve for the future. Okay. And then the third layer, a lot of the protocols actually have the third layer, which consists of, which is the funding is provided by the investors. So these are the token holders that do not participate in the risk assessment. Okay, they put in the funding. If there is a surplus in the risk pool, right, the investment return will be provided to the investors as the investment returns. Okay, will be given to. So that's in the third layer. So you will see that there are about 30 different protocols in the DeFi world at the moment. Right? So we wanted to look at which one is better. Is Nexus Mutual actually hold the key to the success? Right? So we look at all of them. And it turns out this is actually not different so much different from the spatial temporal risk framework, right? Essentially, you just got different practices, but the idea is actually very similar. So actually, you can map them one-to-one to the spatial temporal risk sharing. Okay, so in the last few minutes, let me just show you. What we find out is that because there are different combinations of the structure, right? Some has the first layer, the next mutual is a model with the first and third layer, okay? There's another product called the insurance that consists of the layer 1, 2, and 3. Okay, so we want to compare them. So we run some simulations. We built a model for this, and try to compare these different models by their expected return, the Sharpe ratio on their returns, and the ruin probability. We look at over the 30 periods, how likely the funding provided by the investors would actually go bankrupt. Okay, and as you can see, from the model, so in the panel A, this is the case where there's no profit loading, right? So the expected income is equal to expected outgo for each layer. So we set up the premium in this way, and there's no investment. Okay. There's no investment because, in fact, in a lot of these models, they don't even have the second layer, right? There's no carryover of funding, so there's no need to talk about investment return, right? Okay, so if it's in that case, you can see that in terms of the returns, it doesn't make sense actually to build the second layer. If you look at the second layer in the line of L1, 2, 3, that's the model with the second layer with the temporal risk sharing. Then you see the return on this type of model is actually much lower. It's lower than the ones in which you actually build. I'm sorry. Yeah. The one with the spatial risk sharing actually has a lower return than the ones without. Okay, and they actually are not doing much better in any of the 3 metrics or 4 metrics we introduced. They would only be doing better if you look at the second panel or third panel when we introduce financial returns, and also we look at some profit loading for each layer. And especially in the third layer, we looked at you have to give it enough time to build up the reserve. So if you run the simulation after 30 periods, then they start to make a difference. Right? You can see that after 30 periods of running, then you would see that the financial return on this model would actually be much higher than their counterparts without the second layer. So what this tells us is that most protocols that have been developed in the DeFi market are very the engineers behind them are very short-sighted. Okay, they're looking for high returns, so they built the model without much buffer zone. Okay, and then if you're looking for long-term success, it's very critical, right? Especially for these cyber risks, with high uncertainty at the moment, right? A lot of the new protocols have not stood to time, so it's very high uncertainty. So from a design viewpoint, it's actually better to use some of the ideas, this reserving ideas from the more traditional insurance market, right? So we actually run the simulations for different models. So we listed the 6 top business models developed in the DeFi market, and we want to look at how they perform, how they actually generate returns for the investors. Oh, by the way, if you look for the financial returns for the investors, so they would all appear in L3. L3 is where the investors sit. So you would look at that column for the financial returns, and then if you're looking for long-term prosperity, long-term survival of these business models, then you can see that, in fact, some of the models, Bridge Mutual, for example, in general, they perform better. And then some of the newer models, for example, if you DeFi insured, they have a very relatively high ruin probability. right? I think this is very interesting for academics to look into how this business model perform, and most of the I have to point out most of the engineers and designers of these models are not from the traditional insurance business. Okay, and then they did it mostly from an investment viewpoint. So I think there are a lot of the existing issues with models. So I don't know if I come here again in 5 years, I don't know if many of them will still be there. But I think it's critical that for the industry to look into, to examine how their models would survive over long term. And I think building these models would actually help them help these practitioners understand better how to generate or construct models that would support the industry. The industry at the moment, the insurance industry within the DeFi market is actually very, very small. Right? Used to be, I think they would actually rank top 10 when I first looked at this 3 years ago. But now I think they can hardly make it to the top 20. So it's very, very minimum. And most of the investors in the market are probably very speculative and not really buying a lot of insurance in the market at the moment. But I do think there's a long way to go, and it's very important I think it's also important for us academics to look into this. And maybe, who knows, in 10 or 20 years, right, this should become a useful model for traditional insurers, and one of them may become a disruptor in the market. Okay, so that's all I want to talk about. Thank you very much for your attention.